Hello, students, and welcome to my YouTube channel. Today, we are going to study what is the concept of mark to market in future contract. Before I discuss more on to mark to market, I would like to take you back and will take your minute of your time to explain you again what the future market is all about, the future contract market in derivatives. So, what happens, say, if I ask you that you are interested in buying a share of a company and the price of that share is 50 each, right? So, every share is of $50 and you want to buy 100 shares. So, how much money do you require? So, just a simple calculation that you will do, it's like 100 shares times 50. This means you need altogether $5,000 to buy, right? Now, you have an option to buy and then start doing a trading. But think about it, if I'll give you another option. What is the second option? So, option two says that instead of buying shares, why don't you buy a future contract? And there is a lot size. What is the lot size? That in one future contract comprises of 100 shares, and you can just pay $50 and buy one future contract. So if I ask you that what is the total value that you are holding, so the total value that you are holding will still be 5,000. But how much money are you investing? You are investing only 50. So you are basically here in the first option, you are buying the ownership. So you're buying the ownership. What are you buying in the second option? I didn't ask you to buy share, right? You're just simply buying a derivative instrument. The name of that instrument is a future contract. What is the nature of that future contract? That the underlying security that that contract is having is exactly the same share. So, say suppose you have a this share of XYZ company, and this future contract also holds the same share, which is of XYZ company. So, instead of paying $5,000 and becoming an owner of 100 share, why do you want to do that? Because you believe that in the times to come, there could be a speculation that may happen. You believe that I'm buying at 50, the moment it will become 52, 55, I will sell and I'll book my profits. Absolutely good to go. But for that, you are investing for ownership. So you are buying the ownership by paying $5,000. I said, are you interested in buying the volatility? Right? So, what are you buying by entering into a future contract? You are buying the volatility. And what is that volatility? What is that volatility here? The volatility here is that in terms of if the share price goes up, likewise reciprocation you are going to find in your future contract. So I am going to buy one future contract by just paying $50, and I will have the lot size. So I will buy one contract, the worth of that is 50. Now the question is this, that instead of buying an ownership in a share, I'm asking you to buy the volatility, because you'll be paying less and you are going to get the same benefit of as what the volatility that is there in the right in the stock market. So the only difference is that you are not the owner, you are only buying the volatility. So the excess, you're managing your money. You are basically doing an investment which will diffuse your risk in many ways. And how do we do that? Because we know that future contract are exchange traded instruments. This means that I can't do any customization. I can't say that no, I wanted to buy only 50 shares. So if at all that exchange is having a future contract which holds 50 share, only then I'll be able to buy. I can't do any customization because it's an exchange traded, right? So what happens that, and how do we do the trading in your future contract? So you can see that just symbolically I've shown that in between two investors. So here is a person who want to buy, and this is a person who want to sell. So he's a seller, he's a buyer. And if you remember, the position that the buyer will hold is a long position, and the position that the seller will hold is a short position, right? And we are discussing that how does this take place? How does this whole trading bit take place? In a sense, if I just explain, let me just change the color. Okay. So this is the investor. What does this investor want? This investor want to invest by taking what? By taking long position. What do this investor is making a short position. So he make a short position. This means he is selling contract, and then this long position they are buying this contract, and both of them do not know each other. So the intermediary in between is basically the market, right? Those market which will facilitate the future contract trading. So this is a market which facilitate future contract trading, right? And in order to do so, they said that, look, you have to open a margin account. And to this also, he said that you also have to open a margin account. Now, what is this concept of a margin account? So, a margin account concept is that when you are buying a future contract, there is an initial margin which the exchange is going to ask to both the position holder, whether you are a long position or a short positions, that you need to deposit this much of money. Only then we are going to facilitate your whole transaction. Now, when they are going to facilitate the transaction, sometimes it happens that because it's a tradable instrument, future contract is a tradable instrument, though, so I may have bought that contract at 50, but it may go to 52, it may go to 55, or it may come down to 45 also, right? That what we call that changes in the underlying security will impact likewise the value of your future contract where it is trading in any derivatives market. Right now, the thing is this, that unless and until I have a margin account as a long position holder, likewise as a short position holder, unless the seller is having a margin account, the trade will not take place for the apparent reason because it is daily settled. So the best and the best part of the future contract is that it is not settled by the end of the contract, which was the nature of a forward. It is settled every day. So every day, whatsoever is the closing price of your future contract, that's how the clearing houses do the settlement in between the long position and a short position holder. So this means there is a market in between, and then there is a clearing house which does the settlement at the end of the day. And that is what the concept of mark to market means. So if I'll just again take you back to the mark to market, and you can see symbolically again there is one image which shows that it's like a balance, right? And what is that balance? Because every day it gets settled. So if I'm having a profitability, there will be someone else who might have lost that to me, and therefore in my margin account I'll be up with that amount, and that person would be less by that amount. So the concept of mark to market is that it is a daily adjustment in your future trading in order to show its current market price. And the only reason that why do we have that MTM in any derivatives market in future contract, because it ensures that all gains and losses are basically settled on daily basis in my margin account. In order to explain this further, I'm going to explain this with the help of one of the example which is given in one of the best book which I always recommend to all of my derivative students and to the class, that Options Future and Other Derivatives by John C. Hill, Pearson publication. It is one of the wonderful book I ever came across. Lot of exercises, lot of good snapshots. So it's a must recommended book for all students who are doing any course for financial derivatives. So